Of accounting. There are certain limitations of accounting. The first one is historical in nature. Accounting is historical in nature because accounting is performed on the basis of the cost that has been incurred in getting a particular asset called as the original cost. It completely ignores the current market value of the assets. Adjustments for price level changes should be made. Thus, fixed assets do not disclose the true and fair value, and consequently, balance sheet does not reveal the exact financial position of the business organization. Secondly, records only monetary transactions. Accounting records only monetary transactions, and some very important non-monetary transactions are completely ignored because they cannot be measured in terms of money. Thus, the information that is being provided by accounting records are said to be incomplete because some very important matters are not disclosed because they are not of financial nature and cannot be measured in terms of money. Suffer from window dressing. Window dressing means manipulation of the accounts, of the information by the accountants. There are several methods of recording the values of certain things in the books of accounts. Now, the method that the accountant is using and why he is using it is the main thing that is to be taken into account. There are, say, you want to calculate the depreciation. If the depreciation is calculated by your written down value method, then the amount of depreciation may be less. While if the depreciation is calculated by straight line method, then the amount of depreciation is more. If we are using straight line method, then the profit, net profit, will be less, and if we are using the written down value method, then the net profit will be more because depreciation is a loss, is an expenditure, and will reduce or increase the level of profit. Then personal biasness. Some events are measured on the basis of some estimates. Here the most important thing is the judgment of the person who is estimating the event. In some cases, exact figures are not given, so certain estimates are to be made. Now it depends upon the person who is estimating. Why he is estimating that particular thing? Why is he biased to the business organization or to some other party involved with the business? So there is the judgments of accountants differ from person to person based on accounting concept and convention. As the accounts of business organization are prepared on the basis of number of accounting concepts and conventions, so the operating and financial results disclosed by the financial statements are not realistic because they have been prepared by using certain concepts and certain conventions, and those conventions may or may not be exact, then not suitable for forecasting. Accounting information generally are not suitable for forecasting because of the limitations mentioned above. Now, types of accounting information. The financial statements are used by the users for forecasting, comparing, and evaluating the earning capacity and financial position of the business. These statements are known as accounting information. Every process in accounting generates information which may be categorized as under: number 1, information relating to profitability. This information is obtained from income statement or the trading and profit and loss account of a business organization. It tells us about the earning capacity of the firm. That is how much the firm means the business organization, how much the business organization has earned in form of profit or has suffered loss. Second is information relating to financial position. This information is obtained from the financial position statement or the balance sheet, which provides the information related to the assets and the liabilities. How much assets, how the assets are capable of discharging the liabilities of the business organization. Then third is information about cash flows. A statement that shows the changes in financial position of a business concern during different intervals of time in terms of cash and cash equivalents is known as cash flow. Cash and cash equivalents means cash in hand, cash at bank, all your checks that have been received, all the drafts that have been received, the short-term investments which can be converted into cash after selling them in the market within a period of 12 months. All these are cash and cash equivalents. This information of cash flow helps in deciding or formulating the dividend policy, the financial planning, and the cash budget of a business organization. And the others are providing information for decision, for taking economic decisions. Accounting information is the principal source of information to end users of accounting services, provides information for making inter-firm and intra-firm comparison, provides information for judging the managerial efficiency, provides input for making analysis and interpretation of financial statements, and provides information about corporate social responsibility of the business organization.